how do you buy a home, right? How do you buy a home? I ever show you this? How do you buy a home with the least amount down to make your payment the lowest as possible so that you can own a home today? And what are the benefits of doing that, right? So there are multiple loan programs for buyers, whether you're a first-time buyer or a seasoned buyer. There are government programs that are backed by the Federal Housing Authority, which is FHA, which is part of HUD. There is the United States Department of Agriculture has a rural development program for no money down loan. And if you're a veteran, meaning you've served in the military or you're retired from the military, you can be active, you can be retired. You would qualify for a VA loan, depending on how long you have served and what your entitlement is. And this is always based off of your paperwork. A VA loan is no money down. It's guaranteed by the VA. An FHA loan is 3.5% down. It's guaranteed by HUD. A USDA loan is no money down. It's guaranteed by the USDA. All three of those entities fall under Ginnie Mae, and all of those government types of loans are put into securities with Ginnie Mae, and bankers are trading them on Wall Street, and sellers servicers of Ginnie Mae end up owning the servicing rights, and another entity ends up owning the interest. The agencies guarantee that if you, the borrower, do not make your payments, the guarantee covers foreclosure if those owners of those loans and those sellers servicers that are servicing those loans have to foreclose because you don't make your payments. They can apply for the insurance with one of those three entities at a future date after foreclosure, which comes in a very long drawn out process, and they can get most of their money back. They don't get all of it back, but they get most of it back. So how do you qualify for a VA loan? Number one, for a VA loan, you have to be a veteran or you have to be active military. If you've not either one of those, you can't get a VA loan. How do you qualify for a USDA loan? A USDA loan is no money down, it's rural development, and it's out in the areas outside of city limits of major metropolitan areas. For example, in Southern California, if you want to get a USDA loan, you have to go pretty far out of the city. There is an area along the 15 freeway, which is on the corridor from Corona down to San Diego. There is an area just south of Lake Elsinore that qualifies for a USDA loan. There are other requirements for USDA, but one of them obviously is outside in a rural area. And the second is there are income restrictions that you and your family will have. Depending on your family size, you are allowed a certain dollar gross income. If you're a family of one, that income cannot be as high as if you were a family of 7. If you have 5 kids, you can make more money. And then whatever that max income is, that's the if you make $1 more, well, you can't get a USDA loan. So that's the maximum income that you are allowed in order to qualify for a rural development program. And then we take that income number, and you still have to qualify with all of the other income requirements, which gets into your debt to income ratio for qualifying a loan. Okay, so that is a USDA loan, that is a VA loan. The third loan is an FHA loan. There are limits on an FHA loan. So what is an FHA loan? An FHA loan is a loan that is either for a purchase or a refinance, and it is guaranteed by the Federal Housing Authority, which is FHA, which falls under the United States Department of Housing and Urban Development. Okay, so this is HUD. And an FHA loan can only be for your primary residence, and it can be for up to 4 units. You must occupy that property for at least that first year. What happens after year one, who knows? There are a couple things that will allow you to get a second FHA loan if you have an increase in family size or you are moving geographically for work, right? Or you have had a change in your relationship status, such as a divorce, and you and your spouse end up splitting, you could get a second FHA loan, but it's very rare in those instances. The majority of Americans that can get an FHA loan are only out one at a time. You can get a second FHA loan. I'm not saying you're limited to never having a second. You can just only have one at a time unless you meet those very difficult restrictions. So if you want another FHA loan, you'd have to sell your current one and then look to buy another one. But an FHA loan is a 3.5% down payment. It can be a gift. Your down payment can be a gift from a friend or a family member, right? And you must show your income on your tax returns, W-2s, and your pay stubs to get a FHA loan. Alternate forms of income documentation that we got in are not eligible for FHA loans. And for that matter, alternate forms of income documentation are not eligible for any agency loan. That's where we draw the line between agency loans, which are qualified mortgages, and non-qualified mortgages. We just discussed that. And we'll talk about that some more. Okay? So, what are the income restrictions or what are the income requirements for an FHA loan? Let's talk about this on the board. Okay, FHA loan. What we do to qualify for a mortgage is 3 important factors when buying a home: income, credit, assets. These are the three most important factors for buying a home, right? How much do you make? What's your credit like? What's your score? And how much money do you have for your down payment, or what is the equity in your home? Credit, income, assets. Income, credit, assets, right? To buy a home, we're first going to add up all of your other debts from your credit report. We're going to add up all of your minimum monthly payments. That's going to be your credit cards. That's going to be your auto loan, right? That's going to be any installment loans, such as a student loan. And these are the minimum payments here. This is not the total. These are the minimum payments. We're gonna run a credit report. We're going to add up what all of those minimum dollars are. So let's say your installment loan, your car is $400. Your student loans are $400. Let's say your car loan is $600 and you have $1,000 in other debts and minimum monthly payments for your credit cards. That adds up to $2,000, right? We then are going to calculate what the PITIA is. PITIA stands for principal, interest, taxes, insurance, and association dues. So how do you do that? Well, I have a calculator that I carry around, but let's just say, for example, a $400,000 loan at a 7% has a dollar figure, and I need to have my calculator handy for doing this, but I'm just going to guess at this. This is probably, well, that would be $28,000 a year of interest, which is a little over $2,000 a month. So I'm going to say that is going to be about $24.50 is my guess. Principal, interest. Let's say your property taxes are $1,000 a month. That seems a little high for a $400,000 mortgage, but let's go with it. And let's say your insurance is $200 a month. And let's say that you have mortgage insurance. We're going to get into that a little bit later, but basically $400,000 on an FHA loan, there's an upfront mortgage insurance premium that's paid to HUD for that guarantee, and there's monthly calculation of a 0.85. So we're going to take 400,000 times 0.85, which is going to be about $3,500 a year. We're going to divide that by 12. This is not the exact formula. Of course, there's slightly variances to that, but just for our purposes, we're trying to calculate debt to income ratio here. I'm going to call the mortgage insurance $245. Now, I'm going to make it $250 so I have easier math. So I got $2,400, $3,450, $3,650, $3,850, $3,900. I have no homeowners association dues in this case, because I live outside in an area with no HOA. Yeah, good luck in Orange County. So $3,900 is PITIA plus $2,000. I have total debts of $5,900. The rule for an FHA loan is 29/41. What that means is your gross income times 29%. If your gross income is $10,000 a month, you can only have up to $2,900 for your PITIA, which is right there. And then this back end number takes your PITIA plus your other debt, and that cannot exceed 41% of your monthly income, which in this case would only be $4,100. So your 39 plus 2,000, 5,900. So on paper you wouldn't qualify, but FHA loans are run through an automated underwriting system, which is a internet website that we bankers all log into, and you can go as high with the computer as 56%. In this example, that would be up to $5,600. And in your case, this example, we were making $5,900. So we exceed that number. We have to go and play with these numbers a little bit to work. So what I'm getting at is there's a lot of formulas. There's a lot of variables. The variables is the loan amount, the interest rate, your taxes, your insurance, right? And your credit. Let's say we want to reduce this $5,900 number that you have. Well, you might have a car you only owe $4,000 on. You could pay your car off. Now your $600 goes away and we're $5,300, right? We were $59, now we're $53, and suddenly we qualify for an FHA loan. Okay? How does that sound? I have been doing this my whole life, it seems. I have been helping people writing mortgages for thousands of borrowers for nearly 30 years. Who am I? I'm Lending Man, and that's how it's done.